February 23, 1855. Adams & Company, the largest banking institution on the West Coast, closed its doors in San Francisco. Within 48 hours, every branch in California shut down. Depositors lost everything. No warning, no bailout. Just gone. Total estimated losses? $8 million in 1855 dollars. That's roughly $280 million today. But here's what matters. The collapse wasn't caused by robbery or natural disaster. It was caused by overleveraging, speculation on inflated assets, and a sudden loss of confidence that triggered mass withdrawals the bank couldn't cover. Sound familiar? Because that exact pattern repeated in 1873, then 1893, then 1907, then 1929, then 2008. And right now in 2025, every single warning sign from those previous banking panics is forming again. This video breaks down 3 historical banking panics and shows you the specific pattern that preceded each collapse. The timeline between them, the warning signs, the triggers, and why 2025 looks identical to the setup phase of every major financial crisis in American history. Let me start with Adams & Company in 1855 because it's the clearest example of the pattern. San Francisco in the early 1850s was booming from the California gold rush. Thousands of miners were depositing gold dust and nuggets into banks. Property values were exploding. New businesses were opening daily. Adams & Company wasn't just a bank. They ran express services, handled gold shipments, issued loans, and speculated on real estate. They were everywhere. 43 branches across California. If you lived in a mining town in 1854, Adams & Company was probably your bank. But here's what nobody saw. The bank was overleveraged. They'd loaned out massive amounts against real estate values that were based on gold rush speculation, not actual economic fundamentals. When gold production started declining in 1854, property values stopped rising. That created a problem. Adams & Company had issued loans assuming property values would keep climbing. When values stagnated, borrowers couldn't refinance or sell to pay off debts. Defaults started increasing in late 1854. The bank tried to cover losses by taking deposits from new branches and using them to pay obligations at branches experiencing withdrawals. That's not banking. That's a Ponzi scheme, moving money around to hide insolvency. February 1855, rumors started spreading that Adams & Company was in trouble. A few large depositors quietly withdrew funds. That triggered more withdrawals. Within days, the bank couldn't meet redemption demands. On February 23rd, they closed. Permanently. Depositors lined up outside branches holding receipts for deposits that would never be returned. Business owners who'd kept operating capital at Adams & Company lost everything overnight. Miners who'd deposited years of earnings got wiped out. No deposit insurance. No federal bailout. No bankruptcy protection. Just total loss. And here's the brutal part. The collapse triggered a cascade. Smaller banks that had correspondent relationships with Adams & Company failed within weeks. Credit dried up across California. Property values crashed. Businesses closed. The banking panic of 1855 destroyed California's economy for 2 years. Not because gold ran out, because the banking system built on speculation and overleveraging collapsed when confidence broke. Now let me show you the pattern. Phase 1. Economic boom creates asset price inflation. Gold rush drove property values up in the 1850s. Phase 2. Banks overleverage by issuing loans against inflated asset values. Adams & Company loaned millions against real estate they assumed would keep appreciating. Phase 3. Asset prices stagnate or decline. Gold production peaked in 1852 and started falling. Property values stopped rising. Phase 4. Loan defaults increase, creating hidden insolvency. Phase 5. Loss of confidence. Triggers withdrawals the bank can't cover. Phase 6. Collapse happens in days, not months. 6 phases. Adams and Company in 1855 followed them perfectly. And so did every banking panic that came after. The Panic of 1873 followed the exact same sequence with railroad speculation instead of gold rush real estate. The Panic of 1893 repeated it with silver mining speculation. Subscribe now because Chapter 2 breaks down the Panic of 1873 and shows you how the timeline between panics reveals when the next one is coming. The pattern doesn't just repeat, it accelerates, and 2025 matches the setup phase perfectly. Adams and Company thought they were too big to fail. They controlled 43 branches and handled millions in gold. They failed in 48 hours. Remember that when we get to the modern warning signs. "18 years after Adams and Company collapsed, the pattern repeated. September 18, 1873. Jay Cooke Company, one of the most powerful banking houses in America, declared bankruptcy. Within days, the New York Stock Exchange closed for 10 days. Within weeks, 89 railroads and over 18,000 businesses failed. The Panic of 1873 triggered a 6-year depression, but it followed the exact same 6-phase pattern as Adams and Company in 1855. Just replace gold rush speculation with railroad speculation. Here's the setup. After the Civil War ended in 1865, America went railroad crazy. The government was subsidizing railroad construction through land grants. Investors believed railroads would connect the entire continent and generate massive returns. Everyone wanted in. Banks started lending aggressively to railroad companies, not based on current revenue or profitability, but on projected future earnings from routes that didn't exist yet. Sound familiar? That's speculation, not lending. Jay Cooke Company was the biggest player. They'd successfully financed Union war bonds during the Civil War, so they had credibility. In the late 1860s and early 1870s, they underwrote massive railroad bonds, particularly for the Northern Pacific Railway. The Northern Pacific was supposed to connect the Great Lakes to the Pacific Northwest. Huge project, massive capital requirements. And critically, it was running through mostly unsettled territory with no guarantee of generating passenger or freight revenue for years. Jay Cooke raised millions by selling bonds to investors and keeping a portion as commission. But here's the trap. When bond sales slowed in 1873, they started using their own capital and deposits to buy bonds they couldn't sell. Classic overleveraging. By September 1873, Jay Cooke Company held millions in Northern Pacific bonds they couldn't liquidate. The railroad was burning cash on construction, but generating no revenue. Investors started questioning whether the Northern Pacific would ever be profitable. That triggered the same loss of confidence that killed Adams and Company. Investors stopped buying new railroad bonds. Depositors started withdrawing funds from Jay Cooke. The bank couldn't meet redemption demands because their capital was tied up in illiquid railroad bonds. September 18, 1873. Bankruptcy. The most respected banking house in America failed overnight. And because they were so interconnected with other banks and railroads, the collapse cascaded. 89 railroads declared bankruptcy in the following months. Banks that held railroad bonds got crushed. Businesses that depended on railroad construction contracts failed. Workers got laid off. Credit disappeared. The economy collapsed. Now compare the pattern. Adams and Company in 1855. Gold rush boom, overleveraging on real estate, asset price stagnation, hidden insolvency, loss of confidence, collapse. Jay Cooke in 1873. Railroad boom, overleveraging on railroad bonds, revenue projections fail. Hidden insolvency, loss of confidence, collapse. Identical sequence. Different asset. 18 years apart. And here's what matters for timing. The gap between the Panic of 1855 and the Panic of 1873 was 18 years. The gap between the panic of 1873 and the next major banking panic in 1893 was 20 years. The pattern repeats every 18 to 40 years. Why? Because that's how long it takes for a new generation of bankers and investors to forget the previous collapse and start overleveraging again. The people who lost everything in 1855 remembered. They were cautious in the 1860s. But by the 1870s, a new cohort of bankers who hadn't experienced the Adams and Company collapse were making loans. They heard about 1855, but they didn't feel it. So they assumed they were smarter, more careful, better informed. They weren't. They repeated the exact same mistakes with railroads instead of gold rush real estate. And the panic of 1873 was bigger because the economy was bigger. More banks, more interconnection, more leverage, more catastrophic collapse. That's the pattern. Each banking panic is larger than the previous one because the financial system grows between cycles. But the fundamental mechanics stay identical. Boom drives speculation. Banks overleverage. Asset values stagnate. Hidden insolvency grows. Confidence breaks. Collapse. Subscribe because Chapter 3 covers the panic of 1893 and shows you how the pattern accelerated even further. By 1893, the banking system had learned nothing from 1855 or 1873. They just found a new asset to speculate on. And when that bubble popped, the destruction was even worse. The timeline is what matters. 1855, 1873, 1893. The gaps are getting shorter, the collapses are getting bigger, and the warning signs are forming right now in 2025. "20 years after Jay Cooke collapsed, the pattern hit again. May 5, 1893. The National Cordage Company declared bankruptcy. Within weeks, the Philadelphia and Reading Railroad failed. By June, banks were failing at a rate of 2 to 3 per day. By year's end, over 15,000 businesses and 500 banks had collapsed. The panic of 1893 became a 4-year depression. Unemployment hit 20% in some cities. But once again, it followed the exact same 6-phase pattern. This time the speculation was silver mining and currency policy. Here's the setup. In the 1870s and 1880s, silver mining exploded across the American West. Colorado, Nevada, Montana, massive silver deposits. Thousands of miners rushing to stake claims. Sound familiar? Different metal, same boom psychology as the 1850s gold rush. Banks started lending heavily to silver mining operations, not based on current production, but on projected future deposits they hoped to find. Speculation on speculation. And here's where it got complicated. Currency policy. The Sherman Silver Purchase Act of 1890 required the U.S. government to purchase 4.5 million ounces of silver monthly at inflated prices. This was supposed to help Western mining states and increase the money supply. But it created a massive artificial demand for silver. Banks and investors assumed silver prices would stay high because the government was a guaranteed buyer. So they overleveraged. Loans to mines that weren't profitable on their own became safe because government purchases propped up silver prices. Problem: the Sherman Act was draining U.S. gold reserves. Foreign investors started getting nervous about whether the U.S. could maintain the gold standard. By early 1893, gold was flowing out of U.S. reserves faster than it was coming in. In April 1893, U.S. gold reserves fell below $100 million, the psychological threshold for maintaining currency stability. Panic set in. Investors started converting everything to gold and hoarding it. Banks started calling in loans to build reserves. That exposed the overleveraging in silver mining. When banks demanded repayment, mining companies couldn't pay because their operations weren't actually profitable without the artificial government support. Defaults cascaded. The National Cordage Company bankruptcy in May was the trigger. They'd borrowed heavily to speculate on raw material prices. When credit tightened, they couldn't roll over their debt. Bankruptcy. That triggered fear across all overleveraged sectors. Philadelphia and Reading Railroad failed because they'd borrowed massively to expand during the boom. When credit disappeared, they couldn't refinance. More than 89 railroads failed in 1893 alone, repeating the 1873 pattern, but worse. Banks holding silver mine loans and railroad bonds got crushed. When depositors realized their banks were insolvent, they rushed to withdraw. Banks couldn't cover withdrawals because their assets were illiquid mining loans and railroad bonds. Collapse. Over 500 banks failed in 1893. Not small frontier banks. Major institutions in Philadelphia, New York, Chicago. The financial system seized up. Credit vanished. Businesses couldn't get loans to cover operating expenses. Unemployment exploded. Now look at the timeline. Adams and Company in 1855. Gold speculation, 18 years later. Jay Cooke in 1873. Railroad speculation, 20 years later. Panic of 1893. Silver speculation. The pattern repeats every generation, and each time, it's bigger. Adams and Company lost $8 million in 1855 dollars. The Panic of 1873 wiped out hundreds of millions. The Panic of 1893 destroyed over $2 billion in wealth. Same pattern, exponentially larger damage because the financial system grew. Here's what you need to understand. The asset changes every cycle. Gold, railroads, silver, eventually it'll be housing, tech stocks, crypto. Doesn't matter. The mechanics stay identical. Boom creates speculation. Banks overleverage on inflated asset values. Asset prices stagnate or collapse. Hidden insolvency gets exposed. Confidence breaks. Cascade failure happens in weeks. Then depression for years. Every generation of bankers thinks they're different. Smarter, more sophisticated. They've got better models, better risk management, better understanding. And every generation overleverages on the hot asset of their era and repeats the exact same pattern. 1855 to 1873, 18 years. 1873 to 1893, 20 years. The gaps were consistent. Then something changed. The Panic of 1907 happened just 14 years later. The pattern was accelerating. Subscribe because Chapter 4 covers the acceleration phase. Why the gaps between panics started shrinking. Why each collapse got faster and more destructive. And why 2025 fits perfectly into the timeline of the next major banking panic. The warning signs aren't subtle. They're identical to 1893. Overleveraging on speculative assets, credit tightening, confidence starting to crack. It's all there. Let me show you in Chapter 4. After 1893, something changed. The gaps between banking panics started shrinking. 1855 to 1873 was 18 years. 1873 to 1893 was 20 years. But 1893 to 1907 was only 14 years. Then 1907 to 1929 was 22 years. But 1929 to 2008 was 79 years, with smaller panics scattered throughout. The pattern didn't disappear. It accelerated and amplified. And understanding why tells you everything about what's coming in 2025. The acceleration happened because the financial system got more interconnected. In 1855, Adams and Company collapsed in California and barely affected New York banks. Regional isolation limited contagion. But by 1907, banks in New York, Chicago, and San Francisco were all lending to each other through correspondent relationships. That meant when one major bank failed, the shockwaves hit everywhere simultaneously. The Panic of 1907 started with the Knickerbocker Trust Company in New York, failing on October 22nd. Within 3 weeks, banks across the entire country were experiencing runs. Here's what triggered it. Speculation on copper mining stocks. Augustus Heinze and Charles Morse tried to corner the copper market by buying up shares of United Copper Company. They borrowed massively from banks they controlled to finance the scheme. The corner failed. Copper prices collapsed. Heinze and Morse couldn't repay their loans. The banks they controlled became insolvent overnight. Depositors panicked and started withdrawing from any bank associated with Heinze and Morse. That included the Knickerbocker Trust, one of the largest trusts in New York. They weren't directly involved in the copper scheme, but they had business relationships with the failed banks. Guilt by association. On October 22nd, depositors lined up to withdraw $8 million in one day. The trust couldn't cover it. Collapse. Once Knickerbocker failed, fear spread to every other trust and bank in New York. If Knickerbocker wasn't safe, nothing was safe. Run started on healthy banks. The financial system was hours away from complete meltdown. J.P. Morgan personally organized a bailout. He locked bankers in his library and forced them to pool resources to stop the panic. It worked, barely. But the panic of 1907 proved the system had gotten too interconnected to fail regionally anymore. That's when the pattern changed. Before 1907, banking panics were isolated events. After 1907, they became systemic threats. And that led directly to the creation of the Federal Reserve in 1913. The Fed was supposed to prevent panics by acting as lender of last resort. When banks faced runs, the Fed could provide emergency liquidity to keep them solvent. In theory, that should have ended the panic cycle. It didn't. It just changed the timeline. The Panic of 1929 happened 22 years after 1907. But it was catastrophic. Stock market crashed 89% from peak to bottom. 9,000 banks failed between 1930 and 1933. The Great Depression lasted a decade. Why did the Fed fail to prevent it? Because the fundamental pattern didn't change. Boom in the 1920s created speculation in stocks. Banks overleveraged by offering margin loans at 90% loan-to-value ratios. You could buy $1,000 in stock with $100 down. When stock prices started falling in October 1929, margin calls forced selling. That drove prices lower, triggering more margin calls, more forced selling. Classic cascade. And banks holding margin loans got wiped out when borrowers couldn't repay. The Fed couldn't stop it because the overleveraging was already baked in. By the time the panic started, the system was already insolvent. Emergency liquidity doesn't matter if the underlying assets are worthless. That's the lesson. The Fed can delay panics. They can manage liquidity. But they can't prevent overleveraging during boom times. And they can't stop the cascade once confidence breaks. After 1929, regulations tried to prevent the next panic. Glass-Steagall separated commercial and investment banking. FDIC insurance protected deposits. Margin requirements were tightened. It worked for decades. No major banking panic from 1933 to 2008. But starting in the 1980s, those regulations got stripped away. Glass-Steagall repealed in 1999. Leverage limits relaxed. Derivatives markets exploded. And in 2008, the pattern returned with housing speculation and mortgage-backed securities. 2008 was 79 years after 1929, but it followed the exact same six-phase pattern. Housing boom, banks overleveraging on mortgages, asset prices collapse, hidden insolvency exposed, confidence breaks, cascade failure. Subscribe because Chapter 5 covers 2008 in detail and then maps the current warning signs in 2025. The gap between 2008 and now is 17 years. That fits perfectly into the historical panic timeline. And every warning sign is flashing red. September 15, 2008. Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy. $613 billion in assets. 158 years in business. Gone overnight. Within days, the entire global financial system was on the edge of collapse. Sound familiar? Because 2008 followed the exact same 6-phase pattern as every banking panic since 1855. Just replace gold rush real estate with subprime mortgages. Here's the setup. From 2001 to 2007, housing prices across America went vertical. Average home prices doubled in some markets. Everyone believed real estate only went up. That created the speculation phase. Banks started issuing mortgages to anyone with a pulse. No income verification. No down payment required. Adjustable rate mortgages with teaser rates that would reset higher after 2 years. They weren't lending based on ability to repay. They were lending based on the assumption that rising home prices would let borrowers refinance before rates adjusted. That's speculation, not lending. Same mistake as Adams and Company lending against gold rush property values in 1855. Same mistake as Jay Cooke overleveraging on railroad bonds in 1873. But 2008 had a new twist. Securitization. Banks packaged thousands of mortgages into mortgage-backed securities and sold them to investors. That let banks offload risk and issue even more loans. They collected origination fees and passed the default risk to whoever bought the securities. Rating agencies stamped these mortgage-backed securities as AAA rated, safe as government bonds. Pension funds, insurance companies, foreign banks, everyone bought them assuming they were low-risk investments. But they were filled with subprime mortgages issued to borrowers who couldn't afford to repay. By 2007, the overleveraging was insane. Banks held trillions in mortgage-backed securities on their balance sheets. Investment banks like Lehman Brothers were leveraged 30 to 1. For every dollar of capital, they had $30 in borrowed money. One bad bet, and they're insolvent. Then housing prices stopped rising. That's phase 3. Asset price stagnation. When prices flattened in 2006 and started falling in 2007, borrowers couldn't refinance. Adjustable rate mortgages reset to higher payments. Defaults started climbing. Bear Stearns collapsed in March 2008. They held billions in mortgage-backed securities that turned worthless when defaults spiked. The Fed arranged a bailout through J.P. Morgan. That should have been the warning. But everyone assumed Bear Stearns was an isolated case. They were wrong. By September 2008, Lehman Brothers was drowning in bad mortgage assets. They tried to find a buyer. No one wanted them. The government refused to bail them out. Bankruptcy. That triggered phase 5. Loss of confidence. If Lehman could fail, anyone could fail. Banks stopped lending to each other overnight. Credit markets froze. Businesses couldn't get short-term loans to cover payroll. The entire financial system seized up. AIG, the largest insurance company in America, needed an $85 billion bailout days later. Washington Mutual failed, the largest bank failure in U.S. history. Merrill Lynch got emergency acquired by Bank of America. Wachovia collapsed. The cascade was happening in real time. The government stepped in with $700 billion in TARP bailouts, and the Fed pumped trillions into the system. That stopped the complete collapse, but the damage was done. Stock market lost 57% from peak to bottom. $9 trillion in wealth erased. Unemployment hit 10%. Housing prices fell 30% to 50% in some markets. 2008 was the biggest banking panic since 1929, and it followed the identical pattern. Speculation boom, overleveraging, asset price collapse, hidden insolvency, confidence breaks, cascade failure. Different asset, same mechanics. Now here's what matters. After 2008, regulations were supposed to prevent it from happening again. Dodd-Frank Act, stress tests, higher capital requirements. And for a few years, it worked. Banks were cautious. Leverage came down. But starting around 2015, memory faded. New regulations got loosened. Leverage started climbing again. And banks found new assets to speculate on. Not mortgages this time. Commercial real estate, corporate debt, private equity, cryptocurrencies. By 2020, the system was overleveraged again. The COVID crash in March 2020 should have triggered a banking panic, but the Fed stepped in with $4 trillion in emergency lending and asset purchases. They flooded the system with money to prevent collapse. That worked. But it also created the next bubble. All that money had to go somewhere. It went into stocks, real estate, crypto, SPACs, meme stocks, speculation everywhere. And now in 2025, we're sitting on the same overleveraged setup that preceded every previous panic. Subscribe because Chapter 6 breaks down the specific 2025 warning signs. I'm going to show you the exact indicators that preceded 1855, 1873, 1893, 1907, 1929, and 2008, and then show you how many of them are flashing red right now. The pattern doesn't stop, it just resets. And the timeline from 2008 to 2025 is 17 years. That fits perfectly into the historical panic cycle. Let me show you the specific warning signs that appeared before every banking panic since 1855. Then I'll show you how many of them are present right now in 2025. The pattern isn't hidden, it's screaming. Warning sign 1. Overleveraging on a hot asset class. Before Adams & Company collapsed, everyone was overleveraged on California real estate. Before 1873, it was railroad bonds. Before 1893, silver mining. Before 1929, stock margins. Before 2008, subprime mortgages. In 2025, commercial real estate and private credit. U.S. banks hold over $2.9 trillion in commercial real estate loans. Office buildings, shopping centers, apartment complexes. Problem is, remote work destroyed office demand and e-commerce killed retail. Vacancy rates are climbing. Property values are falling. But banks are carrying these loans on their books at pre-pandemic valuations. That's hidden insolvency. Same as Adams & Company pretending their real estate loans were worth face value when property values had already peaked. Private credit is worse. It's basically shadow banking. Non-bank lenders issuing high-risk corporate loans that traditional banks won't touch. The private credit market hit $1.7 trillion in 2024. No regulation, no transparency. No one knows which lenders are overleveraged until they start defaulting. Warning sign 2. Asset price stagnation or decline. Before every panic, the hot assets stopped going up. California real estate peaked in 1854. Railroad stocks peaked in 1872. Silver prices collapsed when the government stopped supporting them in 1893. Housing peaked in 2006. In 2025, commercial real estate values have been falling for 2 years. Office building prices in major cities are down 30% to 50% from 2021 peaks. Retail properties are getting crushed. But the loans against those properties are still on bank balance sheets at old valuations. That creates a gap. The asset is worth less than the loan. And when that gap gets big enough, defaults start cascading. Warning sign 3. Rising defaults. Before every panic, loan defaults start climbing months before the collapse becomes obvious. In 1855, Adams & Company was covering defaults with new deposits for months before they failed. Same pattern in 1873 with railroad loans, 1893 with silver mines, 2008 with subprime mortgages. In 2025, commercial real estate loan defaults are accelerating. Delinquency rates on office loans hit 10% in some markets. That's higher than during the 2008 financial crisis. And it's spreading to retail and multifamily properties. Corporate loan defaults are climbing too. Companies that borrowed heavily during the zero interest rate era from 2020 to 2022 are now facing refinancing at 6% to 8% rates. Many can't afford the new payments. Default rates on leveraged loans are up 40% year over year. Warning sign 4. Credit tightening. Before every panic, banks start pulling back on new lending when they realize they're overexposed. That creates a liquidity crunch. Businesses that need to roll over short-term debt can't find lenders. In 2025, banks are tightening lending standards at the fastest rate since 2008. The Fed's Senior Loan Officer Survey shows over 50% of banks reporting tighter standards for commercial real estate and corporate loans. That's panic-level tightening. When credit disappears, overleveraged borrowers get exposed. They can't refinance. They can't get bridge loans. They default. And that exposes the banks holding those loans. Warning sign 5. Isolated bank failures. Before the major panic hits, smaller banks start failing. These are early warnings that the system is cracking. In 1893, regional banks failed months before the national panic. In 2008, small mortgage lenders started failing in 2007 before Bear Stearns and Lehman went down. In 2025, we've already seen 3 significant bank failures. Silicon Valley Bank, Signature Bank, and First Republic all collapsed in March and April 2023. They were heavily exposed to tech startups and commercial real estate. Those failures got contained with government intervention, but they exposed the fragility. And now in late 2024 and early 2025, smaller regional banks are showing stress. Stock prices down 30% to 40%. Deposit flight accelerating. Same pattern as before. Warning sign 6. Loss of confidence spreading. This is the final phase before collapse. When depositors and investors start questioning whether any bank is safe, runs start on healthy institutions. We're not there yet in 2025, but we're close. Bank stocks are underperforming. Depositors are moving money from regional banks to mega banks they perceive as too big to fail. Credit default swap spreads on bank debt are widening. Fear is building. Subscribe because Chapter 7 covers the timeline. Based on historical panic cycles, when does this break? What's the trigger? And what happens when confidence finally snaps? The warning signs are all present. The question is timing. Banking panics don't happen randomly. They follow predictable timelines. And understanding those timelines tells you when the next one is coming and what triggers it. Let me map the gaps. Adams & Company collapsed in 1855. Next major panic was 1873. That's 18 years. Panic of 1873 to Panic of 1893 was 20 years. Panic of 1893 to Panic of 1907 was 14 years. Panic of 1907 to Panic of 1929 was 22 years. Panic of 1929 had smaller panics in between, but the next system-wide collapse was 2008. That's 79 years, but the regulations after 1929 delayed the cycle artificially. Strip out the regulatory delay from 1933 to 1980, and the natural cycle runs 14 to 22 years between major panics. Why that range? Because that's how long it takes for memory to fade and new speculation to build. 2008 to 2025 is 17 years. That sits right in the middle of the historical panic timeline. Not early, not late, perfectly on schedule. But timeline alone doesn't cause collapse. There's always a trigger, something specific that breaks confidence and starts the cascade. Let me show you what triggered every previous panic. Adams & Company in 1855, rumors of insolvency spread after a few large depositors withdrew funds. That triggered more withdrawals the bank couldn't cover. The trigger was information. Once people knew the bank was in trouble, the run became self-fulfilling. Panic of 1873. Jay Cooke's failure to sell Northern Pacific Railway bonds. When investors refused to buy new bonds, it exposed that the railroad couldn't generate revenue, and Jay Cooke couldn't meet obligations. The trigger was a failed bond auction. Panic of 1893. The National Cordage Company bankruptcy combined with falling gold reserves. Two triggers hitting simultaneously. One exposed corporate overleveraging. The other exposed currency instability. Confidence broke on both fronts. Panic of 1907. The failed copper corner scheme by Heinze and Morse. When their stock manipulation collapsed, it exposed bank insolvency and triggered runs. The trigger was a failed speculation scheme. Panic of 1929. Margin calls forcing stock sales. When prices started falling in October, leveraged investors had to sell to meet margin requirements. That drove prices lower, triggering more margin calls. The trigger was forced liquidation. 2008. Lehman Brothers bankruptcy. The government's decision not to bail them out signaled that even major institutions could fail. Confidence shattered overnight. The trigger was the government letting a systemically important institution collapse. See the pattern? The trigger is always something that exposes hidden insolvency or signals that protections aren't working. It's the moment when people realize the system is more fragile than they thought. So what's the trigger for 2025? Based on the historical pattern, look for one of three possibilities. First possibility: a major commercial real estate loan default. If a landmark office building or major REIT can't make payments and defaults, that could expose how many banks are carrying bad real estate loans. One high-profile default creates fear that spreads to every similar loan. Second possibility: a shadow banking failure. If a major private credit lender collapses because their corporate loans are defaulting, that exposes the entire $1.7 trillion private credit market. Nobody knows who else is holding bad loans. Fear spreads to all non-bank lenders. Third possibility: a regional bank failure that doesn't get contained. Silicon Valley Bank, Signature Bank, and First Republic all got bailed out in 2023. But if another regional bank fails and the government decides not to intervene, or if the intervention fails to restore confidence, that could trigger runs on other regional banks. Any of those could be the trigger. Or it could be something unexpected that exposes overleveraging in a sector nobody's watching closely. The specific trigger doesn't matter as much as the underlying fragility. Once the system is overleveraged and confidence is shaky, almost anything can start the cascade. Timing-wise, based on historical patterns, banking panics typically happen during periods of credit tightening and rising stress. We're in that phase now in 2025. The Fed held rates high through 2024. Credit conditions are tight. Defaults are rising. Stress is building. Historically, the trigger happens 6 to 18 months after stress becomes visible. We started seeing stress in early 2023 with the first bank failures. We're now 2 years into the stress phase. That puts us right in the historical window for when the trigger typically hits. Chapter 8 covers what happens after the trigger. How fast does collapse happen? What's the cascade sequence? And critically, what can you actually do to prepare when the pattern is this far along? The timeline says 2025. The warning signs are all present. The question is, which trigger breaks confidence first? Once the trigger hits, banking panics follow a predictable collapse sequence. Understanding this sequence is critical because each phase creates different opportunities and risks. Let me walk you through exactly how collapse happens based on every panic since 1855. Phase 1. The trigger event. Something breaks confidence. A major institution fails. A default exposes hidden losses. Or the government fails to intervene when expected. This happens fast. Hours to days. Phase 2. Information spread. News of the trigger spreads through financial networks. In 1855, this took days by telegraph. In 1929, it took hours by telephone and ticker tape. In 2008, it took minutes through electronic trading and news feeds. In 2025, it'll take seconds. Social media, algorithmic trading, instant communication. The speed of panic has compressed dramatically. Phase 3. Withdrawals begin. Depositors and investors start pulling money from institutions they perceive as vulnerable. This creates a liquidity crisis. Banks can't meet redemption demands because their assets are illiquid or underwater. This phase lasts days to weeks. Phase 4. Contagion spreads. Once one institution fails, fear spreads to similar institutions. Doesn't matter if they're actually insolvent. Perception becomes reality. Healthy banks' face runs simply because they're in the same category as the failed institution. This is where cascade failure happens. Phase 5. Credit freeze. Banks stop lending to each other and to businesses. Everyone hoards cash. Companies can't roll over short-term debt. Payrolls can't be met. Supply chains break. The real economy starts seizing up. This is when panic turns into depression. Phase 6. Government intervention. Emergency bailouts, liquidity injections, regulatory changes. The government tries to stop the cascade. Sometimes it works immediately, like in 2008. Sometimes it takes years, like after 1929. That's the sequence. And here's what matters. From trigger to credit freeze typically takes 4 to 12 weeks based on historical panics. Adams & Company collapsed in 48 hours, but the full panic took months. Lehman failed on September 15, 2008, and credit markets were frozen by early October. 4 weeks. So if the trigger hits in 2025, you've got weeks, not months, before the cascade reaches peak chaos. What can you actually do? First, understand what you can't do. You can't time the trigger perfectly. You can't predict which bank fails first or when exactly it happens. Trying to trade the collapse is gambling, not preparation. What you can do is recognize the pattern and position accordingly. History shows 3 consistent strategies that work during banking panics. Strategy 1. Liquidity is king. In every panic, cash becomes the most valuable asset short-term. Not because cash gains value, but because everything else becomes illiquid. During collapse, you can't sell stocks, bonds, or real estate quickly without taking massive losses. Cash gives you optionality. The people who survived and thrived after every panic were the ones holding cash when assets hit bottom. They bought California real estate after 1855 at pennies on the dollar. They bought railroad bonds after 1873 for 10 cents on the dollar that eventually paid face value. They bought stocks after 1929 at 90% discounts. But you need cash before collapse, not during. Once the panic starts, selling to raise cash means you're selling into collapsing prices. Strategy 2. Avoid overleveraged sectors. Commercial real estate, private credit, leveraged corporate debt. These are the modern equivalents of gold rush real estate in 1855 or subprime mortgages in 2008. When the panic hits, these sectors get destroyed first and hardest. If you're holding assets in those sectors, the historical pattern says get out before the trigger. After the trigger, it's too late. Illiquidity traps you. Strategy 3. Recognize that government intervention creates opportunities. Every banking panic in history eventually ended with massive government action. Bailouts, stimulus, regulatory changes. That intervention creates distortions and opportunities. After 2008, the Fed's money printing drove asset prices back up for 12 years. Anyone who bought stocks or real estate in 2009 to 2010 during peak fear made generational returns. Same pattern after 1929, though it took longer. Same pattern after every panic. The collapse creates fear. The government intervention creates opportunity. But you need liquidity to capitalize when fear peaks. So here's where we are in 2025. The warning signs are present. The timeline fits. The overleveraging is obvious. We're waiting for the trigger. And once it hits, you've got weeks to navigate the cascade sequence. This isn't about being pessimistic. It's about pattern recognition. Banking panics have happened every 14 to 22 years for 170 years. The pattern doesn't stop just because we want it to. Understanding it means you can prepare instead of getting blindsided. If you got value from this breakdown, subscribe, because this pattern repeats across markets, currencies, and empires. Recognizing it in real time is the only edge that matters.